year.
Not one stock on the top 40 ending in positive territory. We've seen red blood across the board coming to the fore. You seem very calm for a man that has just seen quite a big sell-off, something we haven't actually seen to this extent for quite some time. Should we be getting worried, Johnny?
Look, generally, I think there are sort of structural issues in the global economy that we've been warning for some time. I mean, the market is still sort of quite healthily up for the year, despite the pullback. But we've argued up at these levels that the market is looking very expensive and is due for a pullback, particularly if you look at the fundamentals in Europe with the deficits and even in the US.
Johnny, if we could also just touch on what we've been seeing coming through from the US, because we had the ADP numbers looking slightly better. A lot of concerns about the FOMC minutes, that they weren't really leading enough, talking about possible stimulus. Do you think that a lot of the things that we have been experiencing, so in other words, the positivity, pretty much hinges on those factors?
Well, I guess the market's been playing a dangerous game with the FOMC. In other words, this risk-on, risk-off trade. So every time the Ben Bernanke talks about sort of additional stimulus, either through lowering interest rates or pumping money into the economy, people have gone out and just bought risk assets, sometimes quite blindly. And they did that again, so through most of the first quarter as there was some talk around sort of QE3. And obviously now that doesn't seem to be on the table. You mentioned earlier that only 2 of the 10 voting members talked about the possibility of additional easing. The sort of risk-off trade is with us again. I think that's quite a dangerous game, just to be buying risk assets simply on the belief that the Fed will pump more money into the economy.
Well, I mean, just looking at the top 40 and from what this tells us, again, commodities are the hardest hit. We've got Kumba down almost 5%, Goldfields shedding almost 5% as well, Anglo Gold down 4.25%. And as you can see, those single commodity companies are basically being the hardest hit right now. What is your sense with regards to the commodity companies? Because we know that they're actually offering far better value than a lot of the other sectors on the JSE.
Look, it tends to vary by commodity. I mean, I think Keo, we think iron ore is sort of grossly overvalued with just too much relying on the demand out of China. So we wouldn't be looking at Keo even at these levels. Gold, on the other hand, I can understand why it has come off post the FOMC meeting. But generally, I think there's at least two reasons to own gold. One is more liquidity being pumped into the market, but also as a hedge against risks that you can't foresee. We still think Europe is in a lot of trouble. Spain had a very poor auction today. Their 10-year bond again now is sort of around 5.25%. So we would still be holding gold as a hedge against nasties. And we think the golds at these levels are very attractive.
The gold mining company, so in other words, you're looking at Goldfields likes of Anglo Gold Ashanti as well. Johnny, would you say that right now you would be buying into these companies in anticipation for much stronger performance going forward, and perhaps breaching that horrible trend that we've seen over the last decade where gold mining companies have actually been grossly underperforming the overall market?
Yeah, that's correct.
Okay, Johnny, let's also touch on the best performing companies on the top 40 today. And I had to say this, Exxaro, the best performing, which is down 0.25%, Growth Point shedding around 0.5%, Steinhoff down around 0.8% or so. So again, a very mixed bag at the bottom. Are you just saying this is basically a knee-jerk reaction to some of the negative headlines?
Yeah, I mean, that would be my reading of sort of today's pullback. We've seen that globally. Australia opened up this morning. The resources were under sort of significant pressure, and that's really continued throughout most of the day. Some of the defensive, some of the property stocks held up slightly better. British American Tobacco was sort of in the green for most of the day, although it closed down. So sort of some rush into some of the defensives.
Let's touch on Old Mutual, stock down around 2% today, ending at 19 Rand and 30 cents. What is your prognosis on this company? I know a bit of news that came through from the company today.
Correct. They declared a dividend back in March in sort of sterling terms, about 21p of dividends, but they only declared the Rand conversion rate today. Obviously, the Rand has been quite weak over the last month, up at around 12 Rand 30. So you're actually getting sort of 2 Rand 65 cents in dividends compared to around 2 Rand 40, which was the expected dividend when they came out with the results in early March. Stocks trading at around sort of 19.30, so you're getting about a 13.5% yield in the next couple of months. I think in a down market, that's definitely a place that we would be hiding in the near term if the risk-off trade continues we've obviously been long mutual for some time and would continue to hold it going into the dividend.
So I'm sure you're smiling that it's down around 2% today. Would you be adding then to your portfolio at all, Johny?
Yes, we would be at these levels.
Okay, let's also just touch on the overall financial sector. It has been said that we could actually see a bit of rotation out of financials and retailers, and perhaps heading into the resource space. Do you think that that is a likely scenario going forward now that we dealt with a little bit more uncertainty?
I mean, there does seem to be quite a lot of sort of sector rotation. I guess the big question is trying to pick the bottom in resources, and then, as we mentioned at the top of the show, just which resources you would be looking at sort of picking up. In our view, sort of oil and gold, and also some of the platinums on the longer term view definitely have some better sort of upside than, let's say, sort of Kio or BHP Billiton.
That's quite interesting when you're talking about the platinums, where we've seen such a significant downturn over the past year or so, and today platinum is down around 3%. Again, just more and more negative news coming through from these platinum miners. Johny, which of the lot would you actually be picking? Would you be looking at Implats, Anglo Platinum, or any of the smaller platinum miners?
Look, I mean, the platinums, is a sort of a sector that we re-entered into last year. As you mentioned, they've been hammered. If you look at where they've come from, sort of the 2008 highs, they're sort of trading now at almost fraction of those kind of values. I think on the platinum, it's probably a slightly longer term story. We do like Impala and Anglo Plats at these levels. Amongst the smallers, I think probably the best two placed are sort of Lonmin. They're looking at sort of moving down the cost curve from the third quartile into the second quartile. If they can manage that, I think there's some good upside there. And then Royal Bafokeng, there is a standstill agreement at the moment where they can't be taken out because Anglo Plat has got a sort of almost a veto, but that falls away come December. And we wouldn't be surprised if one of the other majors looked at Royal Bafokeng in 2013.
Yeah. Johny, what about construction? Stefanucci stocks out with full year headline earnings per share. Trading update expecting to be between 15 and 35% lower. But the truth is, a lot of these construction companies' order books are looking a bit stronger than what we saw before. And we know they could be getting into a coal mining project in KwaZulu-Natal. Are any of these companies enticing you?
Yeah, we don't sort of own Stefanucci. We do own some of the sort of other construction names. I mean, the order books are looking quite good. I guess the concern is that some of the margin that they're likely to be getting on these order books is not as good as it was sort of in the heyday leading up to into the World Cup. But again, some of them have been beaten down and are offering sort of reasonable value.